All right, so this CE class is about the HECM for home purchase. It's not about the HECM refinance, it's about the HECM for home purchase. Today's class is about helping you, the realtor, sell more homes at half cost. And sort of digest that, helping you sell more homes at half cost. I jokingly say this is my first class. I've never taught a class before. But in reality, this is all I've done for 17 years. I'm a certified senior advisor. I'm certified reverse mortgage professional, which is our industry designation, CRMP, certified reverse mortgage professional. I'm only one of 150 in the entire nation certified RMP, CRMP. Only one of 150. So if you will, if I can brag, I'm the expert of experts. And fortunately, I live here in Florida. Today's class is about the HECM, home equity conversion mortgage. I like to say, what the heck is a HECM? Home equity conversion mortgage. That's the legal term. It's sort of like acetaminophen and Tylenol. People call the headache medicine Tylenol, but in reality it's called acetaminophen. A reverse mortgage is a kind of a loan. The FHA version of the reverse mortgage is called a HECM, a home equity conversion mortgage. So let's go and get into some history. History of what we call in general terms a reverse mortgage has been around since 1961. The reverse mortgage program of some form have been around for 55 years or so. The FHA version has been around since 1988. The FHA version is called a HECM. So us as lay people like to refer to the HECM as a reverse mortgage. In reality, it's a type of reverse mortgage. So policy changes, let's go back for a moment. Policy changes over the years since 1988 has made the HECM program, the home equity conversion mortgage, to the greatness it is today. The HECM for home purchase is a twist off of the old reverse mortgage. It actually allows realtors to sell homes using a reverse mortgage, an FHA kind of reverse mortgage. That's pretty exciting. So today's class is about the HECM for home purchase, not so much about the reverse mortgage refinance. So back in 2008, during the Housing Economic Recovery Act, the President and Congress signed into law to allow FHA to do a twist, if you will, a reverse of a reverse, to allow people, realtors, to sell homes using a half-cost home program. Basically, in summaries, you put 50% down and FHA finances the other half into an FHA loan. Pretty cool idea. Over the last couple of years, well, 2009, 2010 is when it sort of got fully implemented. So the program has only been around since 2010. So let's review this real quick. We always like to consider this product a reverse mortgage. So overview real quick. Let's start by talking about reverse mortgages in general. Various types of reverse mortgages exist, and in summary, they're just a no monthly mortgage payment kind of a loan. I like to do this. A mortgage is a mortgage is a mortgage. We all know what a mortgage is, right? You buy a house, you finance it, a bank puts a lien against it, right? That's a mortgage. But as an owner of the property, you have title to it, right? You pay property taxes, homeowners insurance, association dues, but you're the title of it. You're the owner. Just some bank has a lien against it. Now here's the trick question of the day. If I'm a veteran and I buy a house and I get 100% financing, 100% financing, I have no equity, who owns the house? I do, right? I have title to it. Now some bank has a lien against it, but if I were to sell the house I just bought today, tomorrow, for $10,000 more than I paid for it, who gets to keep the profit? I do. If I sell the house tomorrow for a loss, the bank doesn't take the loss, right? I do. So a reverse mortgage, or a HECM, is what we're going to talk about today. In the simplest of terms, is a mortgage. The difference between a traditional mortgage and a reverse mortgage, a HECM loan, is the fact that there's no payments are required. No monthly mortgage payments, as we like to say in official terms. Okay, so reverse mortgages over the years have always been a refinance kind of a program. Typically, you own a house, you may or may not have a mortgage, you do a reverse mortgage kind of a loan, you pay off that mortgage, now you have a brand new mortgage using some kind of a reverse mortgage, and now you have no payments. In the simplest of terms, that's what it is. So in 2008, 2009, FHA came out with the HECM for home purchase. And this is, once again, what the class is about. There's various types of reverse mortgages. A reverse mortgage is not necessarily the FHA HECM loan. A reverse mortgage could be a municipality, a city government kind of a loan, where a senior citizen typically can't afford their property taxes, so they defer the property taxes. That's a type of reverse mortgage, believe it or not. a family or a private type. Investor types, there's proprietary. Equity share, there's actually those kind of reverse mortgages out there. Fannie Mae used to have one called a Homekeeper. Discontinued it about 10 years ago. The jumbo reverse is usually a multi-million-dollar property, and then of course the FHA HECM. And once again, this is about the FHA HECM program. And in particular, it's about the FHA HECM for home purchase. So in general terms, an analogy, a reverse mortgage is like a breed of dog. So we always talk about reverse mortgages as if the HECM is the only kind of reverse mortgage. It's a breed of dog, no different than a poodle or a Labrador retriever, or a type of fruit, no different. You know, is a lemon a fruit, or is all fruits a lemon, right? When we talk about dogs, are we talking about labs or pit bulls? All right, we can't talk about reverse mortgages when we're talking about HECMs. And the reason I'm sort of beating this into you is because all of us, including our industry, calls this program a reverse mortgage. It's like calling all dogs a breed. If you're talking about a Chihuahua, you want to talk about a Chihuahua. If you're talking about a Great Dane, you need to specify what kind of dog you're speaking of. So this happens to be the best and the safest, the most popular kind of all reverse mortgages out there. This is the one that's done 99% of the time, if not 99.9% of the time. It's insured by FHA, it's insured by HUD, sponsored by FHA, it has a fantastic reputation, and according to AARP, of all the people they surveyed, they have a 96% satisfaction rate. The other 4% probably don't know what the heck they're talking about, but we'll give them that. So reverse mortgages, things to know and things to note. All right, call a HECM a HECM. Don't call this product a reverse mortgage. Again, if you're going to call a poodle, call it that. Don't call it a breed of dog. Don't call a HECM a reverse mortgage. The main reason I say that is because reverse mortgages in general have a bad reputation. Everyone agree with that? Yes. All right, and it's sad because those who understand the HECM loan love it. Absolutely love it. I've been doing this for 17 years. I have thousands of clients, and I don't have a single one, I'm not even joking, not a single one has ever said, I wish I'd never done this. This is the worst thing I've ever made, worst decision I've made in my life. No one ever said that. A reverse mortgage is a general term. A reverse mortgage is like a breed of dog. It's like a German Shepherd. A lot of times people hear reverse mortgages, they think of something vicious, like a pit bull. Sorry for pit bull owners and lovers. I look at HECMs as more like a sweet fruit, maybe a Plant City strawberry or a Florida orange, as I like to brag about Florida. Someone comes to you and says, I've got cash money, I want to buy a home. What's the first thing that goes in your head? I'm having a closing next week. Yay. But what really happens? You take them to the $200,000 neighborhood, right? And you show them the houses. And the house they really want, it costs how much? $300,000, because they want the golf course. Now they're moving to Florida, or they're changing homes in Florida, and what they really want is the golf course, right? The swimming pool, the lakefront, at least waterfront. They're wanting something more. This is their retirement home. This is possibly their last home. They want a nice home. But when they say I want to pay cash, what they're really saying is I don't want a mortgage payment. Is that a fair statement? No one really wants to give up all their money, but they're willing to give up all their money in order not to have a mortgage payment. It makes sense. So this is a way for you, the realtor, can take a $200,000 down payment and turn that into as much as a $400,000 purchase. And what does that do to your commission? And what does that do to the lifestyle of your senior home buyer? What happens when they are so excited they just bought a $400,000 house or a $300,000 house for $150,000? They're going to tell their friends and neighbors, right? I mean, this is something that could sort of multiply. But, by the way, the name of this course is called The Morals and Ethics of the HECM for Home Purchase. So I'm going to jump ahead of myself. Don't sell somebody a $400,000 house just because you can. It may not be in their best interest. Maybe a $300,000 house is better. Maybe a $200,000 house for $100,000 down is better for them because of their financial situation. Maybe they just don't need a $400,000 house. Maybe it's too big. Who knows? So the cash out on a HECM, a refinance HECM, remember a HECM is the legal term for a FHA reverse mortgage. So there's two types of HECMs, if you will. There's the refinance kind, which is not what we're talking about today. Then there's the purchase kind, which is what we are talking about today. But it's the same product. If you go to go to Publix and buy an apple, or you go to Winn-Dixie and buy an apple, it's the same apple, probably from the same tree. Right? It's the same product. A refinance is where somebody can pull out 50% approximately of their home's value, and a purchase is where they're putting 50% into their home. Okay? It's the same math. People want to complicate the two. Any company that can do a HECM for home purchase can also do a HECM refinance. So it's the same product, just interchangeable. If I call it a reverse of a reverse, or it could be one coin with two sides, heads and tails. It's the same coin, right? Okay, so I like to use 50% because it's an easy number. In fact, let me say this. This is a 3-hour class. In reality, I want you to remember a couple of things today. It's way too much information for you to remember, and it doesn't even matter. Your job is to sell a home, not to sell a loan, right? Your job is to sell the home. What I want you to remember today is this is a very safe loan, the safest loan in America, if I can say that, Jerry. We'll go over that. This is a 62-year-old product. In other words, you have to be 62 to do this loan. The spouse can be of any age. We'll cover that in a few slides. But 62, it's FHA, buying a home for approximately 50%. That's really, if you remember those things, we're gold. If you have a question after that, you can give us a call. But just remember those things, 62, 50% down. Right? You're good. So, the nice thing about this program is the older a person is, the less the down payment it is. Life expectancy is the reasoning behind that. So a 65-year-old is about 50-50, where a 62-year-old, which is the minimum age, is about 53% down. And an 85-year-old, it might be 35% down. So in other words, you can sell an 80-year-old a $300,000 house for about $100,000. How many people could do that? All of you, right? Huh? An 80-year-old comes to you and says, I've got $100,000 cash money. The first thing you do is like, okay, where do we go looking for a $100,000 home that you want? Right? The further you get away from city, the more likely you are to find a $100,000 home that they like. But now you remember that you spent 3 hours of your life in this course and say, you know something, I can sell you a $300,000 house on the golf course for the same $100,000. Now we're excited. All right, so the rhetorical question, I love this question. How many homes could you sell as realtors if all homes were at half price? Huh? The answer is all of them. All of them. All right, so the HECM for home purchase is a non-recourse loan. Here's Jerry's question. This means that one cannot owe more than the property is valued at, ever. The heirs, the estate, your client, the lender, the loan officer, we're all safe from this loan. So let's digress to 2005, 2006, 2007. We're at the height of the real estate market. Houses are worth more, or selling for more than they're worth, right? Selling for more than they're worth, and someone does a loan, any kind of a loan. They borrow $300,000 on a $300,000 house, and a couple years later the house is worth $150,000. Huh? Is that right? People who had any kind of a loan in those years suffered. Foreclosure, short sales, credit hit. They could have even had an IRS tax bill. Because did you know that if the bank short sales your house, if you short sell your loan, that the bank, with exception of the exception that was made by the federal government at that time, the IRS will send you a bill for the loss, which becomes taxable income. So you lost your home, and you get a $100,000 bill from the IRS, and you owe 33% taxes. You lost your home, you owe $100,000, and now you just got hit with a $33,000 tax bill. The presidential administration waived that for those couple of years because there were so many people suffering. But in normal times, people are hit with an IRS bill. So this is a non-recourse loan. What that means is there's no recourse. Recourse means, you know, coming after you. So non-recourse means that if there's ever a time that the value of the house is less than what is owed on the mortgage. So going back to 2007, 2010, where a house, someone maybe did a HECM loan in 2006 for $300,000. They borrowed $150,000. A couple of years have passed. Now they owe $175,000 because they haven't made a mortgage payment. And now the property is only worth $150,000, and now they're done with it. They decide to sell. They've passed away. They're done with the property. And it's determined at that time that the house is worth less than what's owed. And remember, they're done with the house. They've made a decision to leave, or they've passed away. FHA says that the family, the estate, the client cannot owe more than the value of the house. FHA will insure that loan. So since there's no mortgage payments, you really can't default on this loan. Now, if you don't pay your property taxes, homeowner's insurance, you could default technically on the loan. But as far as the mortgage payments, you can't default. As far as the value of the property, you can't default on the loan. So this is truly the safest loan in America. With traditional financing, if the house is worth less than what's owed, the kids get the debt. And the money comes out of the estate before the kids get the inheritance. This is a non-recourse loan, which means the kids don't inherit the debt. FHA eats the loss. But let's just say that the kids do want the house, but it's not worth what is owed. FHA will allow the family to have a clear title for 95% of the current value. So once again, mom and dad who are now deceased owe $125 on a house that's worth $100. The kids can buy it, or the family can have a clear title for 95 cents of that $100,000. Again, the non-recourse loan protects everybody, including the family. That's pretty cool. Again, the safest loan in America, if I keep beating up on Jerry over here. It is quite amazing.
So they would have to pay, in your example, $95,000 to own the house.
$95,000 to own the house would get them a clear title, yes. Now they're inheriting the house by will, so they have title to it. Now they just have to get a clear title by paying off that mortgage. So then let's use a scenario. Joe asked a question during break. What if you have no will? Does the bank take the house back? No. The state of Florida, I don't know about other states, but the state of Florida says everyone has a will. If you don't create one yourself, we will create one for you. So by Florida law, if you die without a will, everything goes to your spouse. That's easy. If you're the last one and you pass away and you have no will, everything goes to your children. If there's no children, everything goes to your parents. If there's no parents, everything goes to your brothers and sisters. If there's no brothers and sisters, aunts and uncles, cousins. All right? No one wants your house. The state doesn't want your house. The bank doesn't want your house. So I hear that all the time. Well, this is just a way for the federal government to get your house. No. The state's not going to take it either. So they're going to find a beneficiary somewhere. There's equity in the house. If there's no equity, it's easy, right? You just do a deed in lieu of, you foreclose on it, and it's done. But if there's equity, which in most cases there will be, then somebody wants that equity. So they will the state will help find somebody that's your blood relative to get the house to, then they can make a decision what they're going to do with the house. If it's upside down, they can have it at 95 cents on the dollar, and if there's equity in it, they put it up for sale, they take the rest of the money. At no time will the lender take the house. They may take the house in a foreclosure situation in order to sell it, but at no time is the lender going to take the house and take the profit. Worst case scenario is the state takes the house because they can't find any relatives. Okay, so myth versus reality. The HECM refinance, which is, again, a type of reverse mortgage, or the HECM for home purchase, things we've all heard before. So first of all, the lender actually owns my home. Does anyone believe that now? Everyone knows that the homeowner owns the house, that this is just a mortgage that requires a lien that does not actually take over title. The lender, whether it be a HECM lender or a traditional lender, never wants the title. I hear that all the time. Well, the bank really just wants my title. No, they don't. Banks don't want title to your property. They're in the business of lending money, not in the business of selling homes or owning homes. They're in the business of loaning money. Will the loan balance exceed the value of my home? Well, sure, that's possible because we don't know what's going to happen to the economy, the housing market. We also don't know how long a person will be in the house. This is a lifetime loan. Not a 30-year note, not a 20-year note, but a lifetime note. So what that means is if a 62-year-old does this loan and they don't make any payments, now we call this a no monthly mortgage payment loan. I should call it a flexible payment loan because a person could make a payment on this loan. All right, no payments doesn't really mean no, it just means that they're optional. So I'll probably change that terminology. You know, I've been doing this for 17 years and I'm always improving, and that's one of the things I want to improve upon. One of the negativities that we get on this loan is that if I do this loan, eventually I'm going to owe more than the house is worth and I'll leave nothing for my children. Completely not false, because the mortgage payments are optional. If you choose not to make a mortgage payment, then your debt is going to rise, but it's your choice, right? It's your choice not to make a mortgage payment. So will the balance exceed the value of my home? Well, possible. A, the house could go down in value, and B, if your client never makes a mortgage payment, yes, if they live a long time with compounding of interest, and depending on what the house appreciates or doesn't appreciate, it's possible that the balance may exceed the value of the house. But that goes back to the non-recourse feature. You can't owe more than the value of the house. The children will lose their inheritance. Well, completely not true, because first of all, the children don't want the house. Think about that. The children don't want the house. They want the money, but they don't want the house. If they do get the house, what do they typically do with it? They sell it. And why do they sell it? A, because they don't want it. Mom and dad are in their 80s when they passed on. Kids are probably in their 60s. B is there's usually 2 kids, not 1. So what do you do with 1 house and 2 kids? You sell it. 3 is it's mom and dad's house. It's in Pasco County. I live in Georgia. I'm not moving to Florida, or I'm not ready to move to Florida, or I don't like that house. It's not on the golf course. It's not on the lake. They want their own retirement house. The costs of this loan are too high. Well, not completely true, but I'm not going to argue that point because there is some cost. This kind of mortgage does carry closing costs like any other kind of mortgage, but we have another kind of closing cost, and that's called mortgage insurance protection, or in your world, PMI, private mortgage insurance protection. We do things in reverse. That's another joke. It's okay not to laugh. All right, we do have ways to cutting that cost down to 0.5 point. And we'll go over that in a few more slides. All right, so finally, this program is only for lower income seniors. Completely not true. When this program started in 1988, it was strictly 100% refinance. Purchase was not available. Could not do it. The purchase, once again, was not available until 2008, really 2009, 2010. It was passed into law in 2008. But when the program first started, even though it was insured by FHA, FHA said that if you were, in so many words, if you were breathing and you were alive and you owned a house and you lived in it, you qualified. You could actually do a HECM refinance and have zero income. Let's say you're a foreigner, moved into this country, had zero Social Security, zero pension, you're 62 and above, but you had no income. You'd still get approved. You could be fresh out of bankruptcy. In fact, you could use this program to get yourself out of bankruptcy and you're still approved. You just had to be a homeowner, 62, and live in the house. So the program got a little bit of a bad reputation because it's the loan of last resort. If you couldn't qualify anywhere else, then do this one. Well, April 27th of 2015, so about 2 years ago, FHA said, well, hang on a minute. If a person doesn't have income, then how can they pay their property taxes and homeowners insurance? We had a lot of technical defaults in the housing crisis years. People who, in 2010, realized that they had done a HECM loan or any kind of a mortgage loan and had no equity or upside down kind of equity. So a lot of people of all ages said, why even bother to pay the property taxes? I don't have any equity. Some people went as far as giving the keys back to the bank, did short sales and foreclosures, right? And it was no different with this kind of a loan. A lot of seniors said, you know, I don't have any equity. Why am I paying the taxes? Why am I paying the insurance? Some couldn't do it because of the financial crisis, and others just chose not to do it. Because this is a very safe loan, FHA started paying the taxes and insurance on behalf of the senior. But when the house was sold, because most likely in people who did loans in 03, 04, 05, 06, 07, and then got rid of their home in 9, 10, 11, 12, 13, because there was no equity, upside down, FHA had to reach into their MIP, their Mortgage Insurance Protection Fund, and bail out the lenders, had bail out the estate, which means there was a lot of foreclosures, that's a bad word, a lot of technical defaults where HUD had to reach into their pocket. Lenders didn't lose money, seniors didn't lose money, the estate didn't lose money, no one lost money except for the FHA fund. So FHA said, you know, we need to use a little bit of common sense underwriting. From now on, April 27th, we have to ask for income, we have to prove their income, we're going to pull their credit, we're going to verify that they have the responsibility to pay their bills on time. Income versus, some people have income, they just don't want to pay their bills, right? So willingness and ability. When it comes to a purchase program, they actually have to have the down payment money. Just because they are 62 and they want to buy a home, if they don't have 50% down, they're not getting this house. So we're going to verify their assets too. Now, like most mortgages, they have choices. They can do an adjustable rate, they can do a fixed rate, they can do a lump sum payout, which is what most purchases are, because we're loaning them everything they want to borrow. They can set up a line of credit. There's a growth feature, we'll talk about that later. And then they could actually, with the line of credit, they could turn that into monthly income like Social Security. So what is the certified financial planner's thoughts? Well, the good news is that especially since April 27th of 2015, but definitely in the last 4 or 5 years, certified financial planners have actually sort of taken notice of this program and realized that it's a massive, awesome financial planning tool. This is a bucket of money. And for those of you that dabble in financial planning or have your own financial planner, you've heard the term bucket of money. Your IRA is a bucket of money, your savings account's a bucket of money, your house is a bucket of money, your stocks is a bucket of money. Everything's a bucket of money, and depending on what's going on in the world in your life, you may pull money from a taxable kind of an account like an IRA, you may pull money from your non-taxable kind of accounts like a CD, or you may pull money from your home, which is also non-taxable because it's home equity. It's considered a loan. So buckets of money are very important. And also when it comes to financial planning, did you know this? I'm probably getting ahead of myself. Did you know this? That when you're 62, full retirement age is 66, 67, right? If you pull Social Security out at 62, you actually take a reduction in Social Security. If you can wait till you're 70 and a half, you actually get a bonus. And the rule is basically 8% pay raise. So at 62, instead of getting $1,000 a month, you might be getting $700 a month. At 70, instead of getting $1,000, you might be getting $1,300 a month. So it pays to wait if you can, and in your own situation, such as your health and so on. Every year that you wait, you get a basically 8% raise. That's pretty good. But here's what's bad about this, and this is where financial planners love this kind of a loan. If you're 62 and you're still working, did you know that your Social Security is taxed at 50%? Did you know that? 50%. You can lose, it's 50% of the first, the first 15,000 is exempt, and then after that it's 50% up to a certain amount. But you easily lose $5,000 a year in just taxes, just because you're drawing Social Security. So not only are you taking an 8% pay cut per year by taking it early, but you're also in a tax bracket that you shouldn't have to be. Wouldn't it be interesting that if all 62-year-olds would consider this kind of a program, a HECM or a HECM for purchase, HECM refinance, consider this kind of a program to delay Social Security until full retirement age, or even better, age 70 and a half. Because you can borrow money from your home equity with no monthly payments and tax-free. And you can continue to work until you decide to retire. This is a major financial planning tool. I believe extremely firmly that everybody who is turning age 62 needs to look into this kind of a loan. I'm not saying everyone should do it. I'm saying everyone should look into it to determine if this makes sense for them. It's a major, massive financial planning tool. And financial planners have finally gotten on board and realized how awesome this is. So in your course book, this class is not about financial planning. I have a whole class for financial planners. But in your course book is the financial planning PowerPoint that I give to financial planners. If you have interest in learning more about financial planning and the HECM loan, then in your book somewhere you'll find the PowerPoint presentations for financial planners. A lot of the research was based off of Dr. Fowle's PFAU, Dr. Fowle's research. Dr. Fowle is a professor at the American College. He's a PhD. He has formed a designation for financial planners called Certified Retirement Income Planner. It's a national recognized designation certified by the American College. Dr. Fowle is a huge fan of HECM loans in retirement planning. He has done and it's in your book, by the way. He did 10,000 scenarios. In the financial planning world, there's something called a Monte Carlo scenario. And the computer system, you plug in a client's data, their age, their health, their goals, their income needs, when they expect to retire, and then plays the what if game. What if two people at 62 does a HECM loan and one of them dies tomorrow? What if they don't do a HECM loan and one of them dies tomorrow? What if life is good and at age 70 one of them needs long-term care insurance, which really throws long-term care, and it throws a wrench in their retirement plan? You know, what if interest rates go up? What if house values go down? What if stock market does crazy things in a good way or worse? What if? So you ran 10,000 scenarios. Well, that's about everything you can possibly think of. What if, and played this game all the way to age 100 and determined that the only way that a financial plan will survive is if you include a HECM loan in that plan. That if you don't have this plan, that the chances of making it to your desired goals is not going to happen, not likely to happen, because what if something happens? What if something happens? So I want to say this once again. You as realtors have a fiduciary responsibility to help your clients do what's best for them. As I said earlier, this is called the morals and ethics of the HECM for home purchase. So you have the moral obligation to not oversell a house. Just because someone can buy $1 million house doesn't mean they should, right? So you have a moral and ethical obligation to do the right thing. You have an obligation to make sure that your clients are buying the right house. and using the right kind of financing. Maybe paying cash for the house is the right thing. Maybe using a VA loan is the right thing. Maybe a USDA loan is the right thing. Maybe a HECM loan is the right thing. But you have an obligation to make sure that you point them in the right direction. Again, you're realtors, you're not loan specialists. I'm not saying to sell any kind of a loan, but you have a responsibility to make sure that you guide them properly. Any questions? Okay, so when is this loan due? Well, the requirements of this loan is they must live there. So if they cease to live in the property on a permanent basis, if they buy an RV and go traveling for 10 months, that's okay. 11 months, that's okay. If they have a home up north and a home here and they live up there 8 months of the year and here 4 months of the year, that's okay. They must consider this to be their primary home. The borrower or non-borrowing spouse sells the property or changes title. Well, that makes sense. The last remaining borrower passes away, or spouse, fails to comply with the terms of the contract, such as they don't pay their homeowner's insurance, their mortgage, the property taxes, thank you, HOA, HOI. That's a requirement, like any other mortgage. There was an article in the local paper, I live in Orlando, in the Orlando Sentinel, there's an article about 10 years ago. You know, the media likes to sensationalize things. The title of the article said, "Reverse mortgages causes senior to lose home." Here we go again with the bad press. And that's one of our challenges in our industry, is there's a lot of bad press. And when someone dives in and drills down, it's never about the HECM loan. I say never, almost never is maybe a better word. It's almost never about the HECM loan. It's always about something else. So what the article, it was a long article too, what the article was about was the lady didn't pay her property taxes. She lost her home due to not paying property taxes, not because of the mortgage. In fact, if her house was paid for, she would have still lost her home, right? She would have still lost her home if she didn't pay her property taxes. Typically, when we talk to realtors on a one-to-one basis, if I go to a realtor's door and talk to a broker or talk to the gatekeeper, and we bring up the HECM or the reverse mortgage, usually it's just not interested, go away. I've heard too many horror stories. I know of a person myself who has lost their home because of this HECM loan. They call it a reverse mortgage. But when I ask them and drill down, well, it was actually my spouse's first cousin's neighbor's mother. And I don't really know how they lost their home, but I just know they did. Really? Well, how? I don't know. So you really don't know, but you've already made a decision that this is not a good program. When we're done here today, I believe that every one of you are going to love this program, unless you already do. How many people don't like this program? How many people, better still, how many people came here today thinking, I don't really like this program? Be honest. We have one person. That's it. Well, that's good. Usually about half the room raises their hand. Some people, I've never heard about it, I have an open mind. Others said, I've heard too many bad things, but I'll listen. Others already have a closed mind. When you leave here today, hopefully, sir, you will be a big fan of this program. But if you're not, that's okay to raise your hand. I taught a class in Fort Myers a couple months ago, and there was a heckler in the back of the room. And by the end of the class, 3 hours, she was a fan. She came up with all sorts of scenarios. Well, I have a client who did a reverse mortgage, a HECM loan, and they spent all the money, and then he had some medical problems, and they didn't have any money to pay for the medical care, and they wound up having to move. I said, why did they move? Well, because they couldn't afford the upkeep of the house. I said, so what happened to the money that they got from the loan? Well, they spent it. So how is the product the problem of their personal situation? They would have still had a medical problem, except this allowed them to stay there for longer than they would have otherwise. Yes, the end result was bad, but it wasn't because of the loan, it was because of a different situation. And that's one thing that the HECM loans get beat up over, or the reverse mortgage as a general term gets beat up over. So the rules are this. First of all borrowers on title must be 62. For someone who is married, key word is married, they can be of any age, all the way down to age 18. That's pretty neat. What? You're laughing. I have a client right now in Fort Myers who is 75. He's getting ready to do a HECM for home purchase. He's 75 or 70. I think he's 70. Married to a 25-year-old. All right, that's a true story. He's doing his own loan. Now, here's the interesting thing is I didn't want to tell him, I had to eventually, that at age 70, his down payment is about 45%. So he can buy a $200,000 house for $90,000. That's pretty exciting. But he's married to a 25-year-old. We have to use the youngest age when we do the calculation. So his down payment now is 75%. So at first I was trying to avoid that because that's sort of depressing when if I didn't marry this 25-year-old, I'd be, but it is what it is. The good news is that for a 75% down, so $150,000 on a $200,000 house, he has the money, that he's going to be able to protect his wife for the rest of her life. She could be there for another 75 years with no payments. That's pretty neat. So the non-borrowing spouse is protected. Now, remember this. If they're married, the spouse can be of any age down to age 18. If they're not married, then they have to be 62. So two best friends, two sworn enemies, mother-daughter, neighbors want to buy a house together. They all have to be 62 plus unless they're married. We can also do this for more than two people, up to 4. So maybe two couples come together and buy a big house, maybe a duplex, or maybe husband, wife, and mom buy a house together. And you never know, the kids who's 62 and above may get hit by a Mack truck and mom is remaining in the house. And you can do it in all 3 names, that way mom can stay put. For purchases, the borrower must move into the house within 60 days, usually not a problem, right? Most people move in at close of escrow. The last bullet point is pretty exciting. They must have the right to live in this country. Unlike a lot of loans, you have to be a U.S. citizen. You have to be a resident alien. In our world, they just have to have a Social Security number and the right to live in this country. Now, if they have a 6-month work visa, and they buy a house, at the end of 6 months they're asked to leave, well then the loan is called due, right? Because it's not their primary. So I'm not saying to go out and sell a bunch of homes to some people that are here for a 3-year visa, but I'm just saying that they don't have to have a green card to do this loan. The quick answer is if they have a Social Security number, most likely they qualify. Okay. So for property, we can do this for new construction, but the CO, Certificate of Occupancy, must be issued. Whatever you know about FHA loans, sort of erase for a moment, because this is an FHA loan, but we have a whole different provision in the FHA guidelines. What you think you know is not the same as here. So for an example, the green card requirement is not required in our world. So the CO, with traditional financing, you can do all the work you want to, get the appraisal, get the application, do the underwriting. The day the CO is issued, you can have a closing. In our world, we can't even take an application until the CO is issued, which means the builders look at this and say, you mean I have to wait 2 or 3 weeks before I can get the house completely sold? And builders, not necessarily really excited about that. So it's a little bit of a challenge in our world. Now it's possible that come September, FHA is going to wake up and realize that was a bad rule and change that. And we're hoping that's going to happen. There's something going on with FHA that's going to be announced in September, and we're hoping that'll be one of them. When it comes to manufactured homes, yes, we can do those. A lot of manufactured homes are impossible to get financing. Our rules, it must be 1976 or newer. It must be a decent size, 400 square feet. So think about that. 4 by 10 is 40. So what does that come out to? 10 by 10 is 100. So it doesn't take a very big house. 400 square feet. Leased land is usually a problem. In fact, I just found out that leased land is definitely a problem because I can't find a single lender willing to do leased land. It is FHA's, FHA does allow leased land, but think about this, most of the value on a manufactured home is in the land anyways, right? But I can't find a lender willing to do leased land, so we can cross that off. Manufactured home and a land condo are difficult, but we can do them. And a lot of people think that condos are strictly high-rise buildings, but a condo is really just the way a property is titled. So there is single-family homes that are in a land condo. There are manufactured homes in a land condo. Co-ops, cooperatives, not allowed. Absolutely not allowed. There's not that many of them, but if you come across a cooperative, we can't do them. Condominiums must be FHA approved or approvable. What happened was back before 2011, a lot of condos were approved. 2011, FHA, with the condo crisis and the housing crisis, FHA eliminated all condos in America. All 50 states, all the territories said no more condo in America is approved. If you want to be approved, you have to reapply, because a lot of condos were a financial disaster. They're finally coming back, but they were a financial disaster. So what's happened is because a lot of condos were changing ownerships, a lot of investors in there, a lot of the boards have changed, the managements have changed. A lot of the management, a lot of the board presidents and board members don't understand the advantage of getting their building FHA approved. It's a badge of honor to let everyone know that their building is well run, well managed, well financed, and so on, mostly owner occupied and such. So most buildings are not approved today, but most buildings could be approved if they took the time. So there is ways of getting it approved at no cost to your client or to the building. There is cost associated with it, but a lot of lenders will absorb that in order to get the loan. So if you have a building that you'd like to sell units in, let's get it approved in advance before you go out and find customers, before you try to get listings under this program. Duplexes, triplexes, or quadplexes are okay. Now check out this. You can do a quadplex. As long as your client lives in one, we can finance the entire plex. And they can rent out the other 3. Now, speaking of financial planning, imagine if they bought a $600,000 quadplex. I don't know what that would do to your commission, but I'm sure it would be nice. They live in one, and they rent out the others for $1,200 a month. $3,600 cash flow every month. They have no mortgage payment, and they have cash flow. And they have a property that's increasing in value. That's pretty cool. So again, financial planning. Single family homes, townhomes, villas, cluster homes. What's interesting is pretty much every property out there qualifies. Condos, manufactured homes, a couple of rules. But anything other than that, call it a duplex, a villa home, a cottage home, call it single family, call it whatever you want to call it. And chances are it's okay, because it's considered under the classification single family. A modular home is basically a piece of house that comes on the back of a truck and is usually lifted onto a foundation. That's considered a stick-built home in our world, so we're fine. A manufactured home, in a raw definition, is where they pull it behind a semi and they park it, take off the wheels and the tongue. That's a different set of rules. Houses must be FHA approved, meaning move-in ready, no fixer-uppers. It's okay to sell homes that are as is, but when the appraiser comes in and notices that the kitchen faucet is leaking, or the stove is missing, or the back door doesn't lock, it's going to have to be fixed before closing, because it needs to be move-in ready. And we don't care who fixes that problem. I had an appraiser who noticed there was a crack in the toilet. The bank was selling the house as is. The bank refused to fix the toilet. What do toilets cost? $100, right? Right, installation maybe. The buyer was a handyman. He says, I'll fix it. If the seller will let me in the house, I will fix it so we can close, because the seller refused to fix the toilet. As is, no negotiation. The deal was going to fall apart. So we got the buyer in and fixed the toilet. We had a closing. No, so let me just reiterate that. All repairs must be fixed prior to closing. There's no repair set aside. Move in ready. Unlike a lot of FHA loans, move in ready. Okay, so down payment funds and sources. This is sort of exciting. So unlike traditional FHA financing, there's a lot of rules. We can actually, let's skip down to the last one. So gifts from friends. FHA doesn't allow that, but they do in our world. So we have to verify that they're actually a friend. How do we do that? Maybe Facebook, maybe a childhood photograph, maybe some kind of proof that they've been friends for 10 years or 5 years or whatever it is. But so far I've actually never done that. We do a lot of loans, and so far I've actually never had a friend actually give money away. But it is possible. That's exciting. So the money must come from their own accounts. It must come from their own checking, savings, investments, retirement accounts. They can get it from their home sale that they just made or making. They can actually get it from their whole life insurance policy. They can sell assets. I put gold in here because I actually had a client who sell some gold. He had a safe full of gold. That was his safety net. And gold is really cash, and you really can't trace cash. So how do we source that money? We have to source it. Well, fortunately, 3 years ago, he had bought the golds with serial numbers, and fortunately he sold the golds with serial numbers, and we were able to trace the fact that he bought them and sold them. So we were able to use that. So not acceptable kinds of down payment money. You cannot borrow any money. So how many realtors here have sold a house to somebody of any age? And the basic rule is you buy a house, you're supposed to keep it for about 5 years in order to recover the cost of buying that house, right? give or take, depending on what's going on. If someone comes to you and says, look, I'm going to be in Florida for a year, I just want to buy a house for a year, it's probably not advisable, right? Because of closing costs. But what happens in reality is that people buy and sell all the time. And maybe they buy and sell because they've gotten some additional equity and they want to improve their home, or maybe they just don't like the area, or maybe they are needing to move for a job reason or whatever. So this loan's the same way. Ideally, because of closing costs, this should be someone's last home. But not always. Yes, there's closing costs. And because of the MIP, the closing costs are a little bit higher than traditional financing. And yes, the basic rule is 5 years, you should stay there. But just because someone says to you that I'm planning on moving one more time in retirement, doesn't mean that this is not a good loan. Maybe they should be a renter. Maybe they shouldn't be buying at all. But it needs to be considered. Maybe the answer is that they do this loan because they can get it, double the house, right, half the cost, and then go ahead and make payments. Remember, this is a no payment required mortgage, but required is the key word. They can make payments. Now, we have two types of financing. We have the fixed and we have the adjustable. A fixed rate is a closed loan, so there's no, you can make payments, but we're not going to give it back. But the adjustable rate reverse HECM loan allows for a line of credit, which means that any payments that are made actually go into a line of credit, reduces the principal, and goes into a line of credit that can be reborrowed at no charge at any time. No payments are required, which means if no payments are made, there's no 1098 at the end of the year for a tax deduction. I usually get that question. But if they do make a payment, the first part of that payment goes to the MIP and the interest, which is tax deductible, before it goes to the principal. So the interest portion of that is tax deductible. They'll get a 1098 so they can actually take it off their income taxes, which goes back to financial planning. If you need a tax deduction this year, maybe you should make some payments into your line of credit to get a 1098 to reduce your taxes, only to reborrow the money at no charge after you make that payment. Think about that for retirement planning. We got a laughter over here, but it's pretty cool, huh? Again, this is a loan that should be considered by everybody that's 62. Sit down with a financial planner that understands this kind of a loan and do a Monte Carlo scenario. Do some scenarios. What if? Maybe this kind of a loan will help you purchase long-term care insurance. Maybe this kind of a loan will help you buy an investment property or help your children buy their next house. I say you, I'm referring to someone, your client, 62 and above. Maybe this kind of a loan will help your children buy their first house. Or maybe this kind of a loan will help your grandkids go through college. Maybe this kind of a loan will just give you some cash reserves in case something comes up. Your RV gets a flat tire. Your roof leaks. Maybe this kind of a loan gives you just a pool of money just in case. You know, the what if game. So non-allowable funds. You cannot borrow money to borrow money. This HECM loan, the FHA, will not allow a person to go borrow money for, let's say, from their existing home, a home equity line of credit, or get a down payment assistance program, or will not let them borrow money to do this loan. The money must be their own or must be from a relative or a friend, but it must be gifted, not lent. So you can't go get a home equity line of credit, you can't borrow money to borrow money. So no subordinate financing, no personal loans, you can't go to the credit card, you can't even put your escrow deposit, earnest money down on a credit card. I've had people do that. That's borrowing money, you can't do it. Loans against anything. So the cost, all right, here's the good stuff. The appraisal fee now is up to $500. I need to change that. I'd say when I started this 17 years ago, appraisals were $250, and now they're $500. All right, so origination fee. All right, that's points, if you will. That's what the lender charges to do this loan. FHA allows us as lenders to charge as much as $6,000. Depending on the value of the home, we can charge up to $6,000. A $600,000 home, we're going to charge $6,000. A $100,000 home, the most we can charge is $2,500. But somewhere in that range, we're going to charge. A lot of lenders, including the lender I work for, charges zero. For a purchase, no charge. The reason is because the lenders do make money off of the interest rate. And on a purchase, most people borrow as much as they possibly can so they can put down as little as they possibly can. Makes sense. So lenders make enough money where they can charge zero origination. So one of the myths, and I'm going to call it a fact, of this kind of a loan is it's an expensive loan. Well, the good news is most lenders, including our lender, does not charge anything. Zero. That's pretty cool. So the other sets of fees would be the third-party closing cost, normal closing costs, doc stamps, intangible tax, survey, recording fees, title insurance. and the FHA fee. The FHA fee is normally 2.5% of the appraised value. In our world, everything's based on the appraised value. Unlike a lot of lenders, it's based on the loan amount. In our world, because there's no payments required, it's based on the appraised value. So 2.5% of the appraised value. If you sell a $200,000 house, 2.5% of that is $5,000. So in addition to about $5,000 in third-party closing costs, you also have $5,000 in FHA fees. So closing costs are about $10,000. There's no lender fee, so that's zero, that's good. It could be on a $200,000 house, could be $4,000. So the good news is closing costs are lower. Now here's some more good news. The 50% down payment requirement that I've asked you to remember, I've only asked you to remember about 3 things, right? 3 hours, 3 things, we got this. The closing costs, the $10,000 in this example, is included in the 50%. So if someone comes to you and says, I have $150,000, sell me a home, you can do the math in your head real quick that you can sell them up to a $300,000 house for the $150,000, including the closing costs. Pretty cool. So the closing costs are rolled into the loan. What's not rolled into the loan is the $500 for the FHA appraisal and the $125 for the counseling. So unlike most mortgages, most loans, the person can just buy a house. In our world, because the seniors are a protected class, FHA requires them to go through a counseling session over the phone usually, about an hour, to have them explain what a HECM is. That no payments are required, that this is a safe loan, it's a non-recourse loan, you got to pay your taxes and insurance and so on. That you have a right to get a fixed rate that's considered closed, or an adjustable rate that is considered open, which means you have a line of credit. So they go over that. Now, all loan officers go over that anyways. But FHA wants to make sure it was discussed so your buyer understands the pros and the cons of this loan. It's just an hour session, so it's not going to be in-depth. I still recommend that a financial planner gets involved, one that understands the HECM loan and likes it. There's still financial planners out there that haven't quite learned how awesome this is and may poo-poo it right out the gate. But anybody who understands this program loves it. So how do you get down to 0.5%? So FHA says the minimum down payment is around 50%. Minimum down payment. But what if someone says, I want to pay cash for a house? And the main reason I don't want to pay cash for a house is that I don't like that 2.5%. If you want to call this an expensive loan, well, that's why it's expensive. But it's for insurance. And if you really zero into the cost of the insurance, it's actually a pretty good deal. What kind of lender would guarantee you that you can never be hurt by your house or your loan? Who would guarantee that? And for a fee of just $5,000 or 2.5%, it's actually pretty cheap insurance. It may be one of the best insurances you can buy. It's not optional, by the way, it's mandatory. But what if someone says, well, I really have the ability to pay cash? And having the ability to buy a $300,000 house with a stroke of a check, that's like a badge of honor, right? It's a trophy. I would feel good if I could write a check for $500,000, pay cash for a house. Just the pride I get from that is pretty awesome. But $250, I like that because I can keep the other $250. I pay $250 for a $500,000 house. I keep the other $250 in the bank for emergencies. I like that idea. But I have the ability to pay cash for a $500,000 house, and I don't like that 2.5%. So what can I do? So FHA realized that when they came out with this program a few years ago and said, and this is actually a modification, so about 3 years ago they came out with this modification and says, for those who have the ability to pay cash for a house, for those who have the money, we will allow them to put down more money than the required 50% and reduce their FHA fee, the insurance fee. We'll reduce it by 80%. 80% of a reduction of 2.5 is a half. They can go from $5,000 to $1,000. That's a pretty significant reduction for those who have the ability to pay cash. So FHA requires them to put down approximately, don't write this down, approximately 22% down, more down of the purchase price. So on a $500,000 home, that's about $110,000. So they put the $250 down, plus another $110, so they put $360 down, and they get the reduction of the MIP fee. Now, that's awesome, but it gets better. The $110,000 they put down, that they didn't have to put down, goes into a line of credit that FHA will let them have 1 year later. A line of credit, standby emergency fund. Remember, these are people who can normally afford to pay cash. They have $360,000 in this example. They don't really need the money. And to get a well, let's use some real numbers. A $500,000 house, all right, pretty nice house. 2.5% of $5,000 is $12,500 MIP fee. That's a lot, right? And for somebody who has the ability to pay cash, well, maybe I don't want to pay that kind of money. Well, we can reduce that from $12,500 to $2,500, right? 80%. If they're willing to put down $110,000 more on a $500,000 house. Everyone with me so far? A year later, we will let them have access to the 110. Standby line of credit, or just withdraw it all at once, or just take chips away at it. They can do what they want to, but that's the rule. But the $10,000 discount they got gets added to the line of credit as well. So they don't have 110, they have 120. That's pretty cool. And you think it can't get any better than that? Again, financial planning. During the year that they have not touched this money, because they're not allowed to, because they got a $10,000 discount, FHA's line of credit will grow that $120,000 at approximately 5.5%. Well, I got some nods on that one. What? FHA, when they designed this program, remember, the HECM for home purchase is really just a twist off of the old HECM refinance, reverse mortgage. So when the HECM was designed back in 1987 and passed into 88, it was supposed to be a financial planning tool. It was supposed to be all along. The reverse mortgage HECM really didn't take traction until about 2003. It really didn't take traction for the first 15 or so years. Most people had never heard of it until the media got on board in 2002, 2003, and then people started hearing about it, but not really understanding what it was. So it's only been around, if you will, for about 15 years in the general knowledge sense. So it was supposed to be a retirement tool. It was supposed to be a way for people could supplement their Social Security. So in order to encourage people not to take all the money, an equity strip, if you will, let's set it up in a line of credit and let's send you a monthly check, just like Social Security. Let's set up a line of credit where maybe you withdraw from it a couple times a year to pay your taxes. And then during the housing bubble, people caught on to this and started equity stripping. 2005, 2006, that was the height of this industry. A lot of loans were done. People were living in houses that were worth more than, or were valued more than they're actually worth. People were just withdrawing money. I mean, you've all seen it. Anybody who's been in the business long enough to know, people were getting mortgages, including reverse mortgages, left and right. Everybody, when I got in the financial planning business 25 years ago, most of my clients who were 65-ish did not have a mortgage or almost had paid it off. They were very proud about that. I had a mortgage burning party. Nowadays, almost everybody has a mortgage. Is that a fair statement? It's absolutely amazing. And some people don't really want a mortgage today, but their banker may have talked them into one in 2006. Just get a $20,000 line of credit just in case. Well, when you have access to money where you're only paying interest on the HECM or the HELOC, let me just pull some money out, I'll pay it back later. Before you know it, they go get a $40,000 HELOC, and then an $80,000 HELOC, and then a $100,000 HELOC. Now they're living off the HELOC, because now they got to make mortgage payments, even though it's so small. And then 2008 hits, and banks started freezing the lines of credits, the HELOCs. By the way, this loan can never be frozen. They started reducing the line of credits, created a financial problem. Then they found out that their house wasn't worth what they owed. A lot of senior citizens have mortgages now. It's sad. I'm doing a loan, helping a gentleman right now who drives a Ferrari California, has one of those 7 Series BMWs, lives in $1 million house, and he's doing a HECM loan. He's got $2 million in an IRA. All right, he's an awesome retiree. But on a $1 million house, he owes $400,000 in a mortgage. Now, I don't know why he has a $400,000 mortgage. Maybe his financial planner told him it was the right thing to do because you get interest deductions, who knows. But he has a $400,000 mortgage, and he could certainly write a check and pay it off. Except $400,000 from an IRA would cause a taxable situation, but he could. This is pretty exciting. So once again, for those who can afford it, could actually stroke a check for larger than the 50% down, put the difference in a line of credit for a minimum of 1 year, get a 5.5% growth, and get the $10,000, the 80% difference, added to the line of credit. If they want it in a year, they can take it all. If they don't want it, they can leave it there. Pretty amazing. I don't do too many of these, but I've done several. I always bring this up when I talk to a client. I said, you know, this is a financial planning tool, and you need to understand it. You know, do you have the ability to write a bigger check, and do you need the money? A lot of times people sell a house up north, they have extra money, they don't really need it. They have the money to do it, so why not? It makes a lot of sense. Okay, so what's next? Once you've identified a home buying senior, let's get them pre-approved. Let's make sure that they have enough credit. Now, we don't care about a credit score, but we care about their credit history. Have you been paying your bills on time? Do you have the willingness to pay your bills on time? We look at their income. Do you have enough income to pay your taxes, your insurance, and maintenance of the house? We look at what shows up on a credit report as far as a car payment, another house payment, maybe they have a vacation property or a second home. And do you have enough income to pay those mandatory bills and have enough money to pay your taxes and insurance? Every now and then we get somebody who wants to buy a bigger house than they can really afford. So not only the first line of defense is for you, the professional realtor, is not oversell the house. The second line is for us to make sure they can actually afford that property. So it's okay to have multiple properties. They can have 20 other properties. We don't care as long as they can afford them. And if they have them rented, we can consider that income, and there's all sorts of ways of doing it. But once you've identified your home buying, senior, contact your loan specialist, get them pre-approved, and then go shopping. Go shopping for their dream home. And remember, once again, if their budget is $300,000 and they're going to put $150,000 down, you might want to take them to the 250 neighborhood first and work them up versus taking them to 300 and have to bring them back down because they can't afford something larger. Go shopping for a home, write the purchase contract. We're going to go over that. Closing is about 4 weeks. Now, we can actually do it in 3 weeks. Most lenders take 6 weeks, and we just got to clear to close in 10 days on a purchase. We're pretty proud about that, but that's the exception, so don't count on that. But 4 weeks is pretty realistic. We do not have TRID. Our industry still uses the HUD-1. We don't have TRID. We don't have all those rules that other lenders have, which is awesome. We can do things better. Verifying clients, this is the loan officer's responsibility, actually the processor's responsibility. We are going to pull their credit. We don't care about their score. We are going to verify monthly expenses. We're going to verify income. We're going to, actually, if they're self-employed, we need 2 years tax returns. If they're not self-employed, we skip that. Any large deposits must be sourced. If they're using money from different bank accounts, which is pretty typical, they've got money in savings in one bank, they got money in checking in one bank, they have money in checking in a different bank, and they're pulling the money together to buy this house, we're going to get 2 months from every bank. Everything has to be sourced. For those of you that work with your mortgage guy, when you sell a home, you know how daunting it is with credit these days, right? It is not easy. A lot of our clients haven't bought a house in 10 years. And 10 years ago, they just signed their name and they got a house, right? And nowadays, we want a drop of blood in probably their firstborn. It's just the way credit is nowadays. And we're no different. Our loan is easier to qualify for as a whole because we don't have a debt-to-income ratio. Hear me? That's 42%. We don't have that in our world. If somebody has $5,000 of income and $4,000 in expenses, they're still qualified with us because they have enough money. That $1,000 extra is enough money to pay taxes and insurance, depending on the value of their house. So we don't have a debt-to-income ratio, but we do have verification of how much income do you have and how much debt do you have, and do you have enough to pay for your normal bills plus your new house. So we do have that. We call it common sense underwriting, and sometimes I pull my hair out because it's not really common sense. Do we really need the annual statement, or can we just look at their bank account and see it's deposited? So interesting enough is we do have to have the annual awards letter from Social Security, and we have to show in their bank that the money is actually deposited, which is redundant, I know, and this is why I'm bold on certain parts of my head, because really, is that common sense? Is that what I call logical? But we do. Now, a lot of people will get their annual statement and throw it in the garbage. All right, but that's okay. We will help them go to ssa.gov and download their annual awards letter. But we do this all the time, so it's easy for us. If they sold another home, which is pretty common, the last one here, if they're using the other home to buy this home, we just need to source it that they actually did get the money. If they're using money from their own bank account, it needs to be sourced for 2 months. So if they're selling a home, it doesn't have to be sourced because they've got the asset, we're buying the new asset. If they're using cash, it has to be in their name for 2 months. If they're getting a gift letter, we don't need that because it's a gift from somebody else. But I've had people will go out and get a home equity line on a different house and immediately try to use that to buy another house. Well, remember, you can't borrow money to borrow money. So they have to source, they put that in a savings account, let it sit there for 2 months to season it, and then we can use it because we only go back 2 months. Okay, so sales contract. All right, first of all, fill out the sales contract the way you normally fill it out. I had a realtor friend, I still have a realtor friend, who 6 years ago, I educated him. He's my friend, so I went to him first and said, oh my gosh, we got this amazing program. This is going to help your clients by double the value of the house. You're going to increase your commission, half price homes, oh my gosh. And he listened to me, and he got excited, like hopefully everyone in this room is right now. He got excited. And then a year or two passed, and I went back to him and I said, how come you've never given me a referral? And he said to me, he got this dumb look on his face, and I say this again affectionately, he got this dumb look on his face and said, I don't know what to do. I said, what do you mean you don't know what to do? Okay, I'm sitting at a table, I got the senior across from me, I got a purchase contract in front of me. What do? I said, well, you fill it out. But I've never seen a purchase contract before, so I got one, and I looked at it, and I read it. And guess what? There's a box right there that says FHA mortgage financing. Well, that's what we're doing. We're doing an FHA loan. Now, it's called a HECM, so you could write in HECM if you wanted to, but it doesn't matter because the seller has never heard of a HECM. And the seller's agent's going to look at FHA financing with 50% down. What happened to 3.5? Why would someone do that? All right, is that pretty fair? Why would someone do that? So you're going to have to explain to the seller what we're doing. Yes, this is an FHA loan. It's called a HECM. It's 50% financing. You know, here's the pre-approval letter. Doesn't matter. It just makes a lot of sense. So the seller and the buyer and the seller and the seller's agent is going to scratch their head and say, what the heck's going on? So it's okay to explain them. But I caution you, do not call a HECM a reverse mortgage. Again, it's a breed of reverse mortgage, but it's not a reverse mortgage, it's a HECM. A HECM is 10 times better than any reverse mortgage out there. Again, there's the tax deferment reverse mortgages, there's the jumbo, the proprietary, it's the equity share, it's the high interest rate reverse. There's all sorts of reverses, there's all sorts of breeds of dogs, types of fruit. But when it comes to a HECM, there's nothing better than a HECM. It's the best loan in America, and I say that, and I mean that. All right, so because we're a different breed, we also have other issues that are sort of strange in our world. No seller concessions. The seller cannot pay anything towards the buyer's closing costs. And this goes for builders too. The seller cannot pay for the title policy. Whoa. The seller cannot pay for any portion of anything. Can't even provide a home warranty. As crazy as that is, that's what FHA did when they created this program. Makes no sense whatsoever. Now, come September, that all may change, and we're anxiously waiting on that. But right now, if a builder wants to give $10,000 in free upgrades, well, that's fine. They can give it. They just can't put it in writing. If the seller wants to provide the title policy, which is valued at $2,000, well, we can't do it, because you've got to put that on the HUD-1. So it's just unfortunate. So the best thing to do is just negotiate for your buyer to lower the purchase price, offset that. If the seller's willing to pay for it anyways, just do a better job negotiating. It makes sense. And actually might, speaking of that, when you are making an offer, because especially in today's world, as Joe was pointing out, houses are selling like pancakes right now, right? They're just, it's crazy out there. I think houses are selling for more than they're worth, but that's another subject. Anyways, we could be in some kind of mini housing bubble, but in the meantime, you're trying to get your buyer to get this house. The listing went up 2 days ago and they've already got 10 offers. So what can you do to help your buyer get that house? Well, guess what? Your buyer's going to pay all the closing costs. That's pretty huge. That certainly makes your offer probably better than anyone else's. They're going to pay for the title policy. They're going to put 50% down. That's pretty awesome. They've already been pre-approved. There's pretty much nothing that can go wrong. Well, anyways. Any questions so far? Okay, so buyer, since the seller cannot pay for the title policy, then I urge you to let the buyer choose the title company, because this is a different kind of a loan. And the reason I'm telling you this now is because all of us have our favorite title company, especially if you're a listing agent, and you all want to do a kindness to your favorite title agent, and you want to use your title company because you know them and you trust them. And we've been doing this a long time, and every title company has told me, oh yeah, we do this all the time. Yeah, we know what we're doing. And then we get to closing and it gets delayed. And then people get upset because closing didn't happen on time. I got a couple nods over here. And the closing didn't happen on time, which means you didn't get your paycheck on time. The seller's upset, the buyer's upset. I urge you to allow the lender, basically, to choose the title company. It will make things a lot better. Now, we can educate your title company. Maybe the first deal, we just get it done the quickest and best way, but in the meantime, we have identified a title company that would be willing to do your title work. Let's get them educated. Let's get them approved, because they have to be approved too.
The title company has to be approved?
By the lender, yes. Because this is a different kind of a loan, there's so many, the fees are calculated differently. You know, title is title, I get that, the search. But the fees are calculated differently. There's so many things that are different. I want to say 100% of the time, but maybe I'm exaggerating, but pretty damn close, darn close. 100% of the time, when we use a title company that doesn't do this on a regular basis, the closing doesn't happen on time. One example is we don't do TRID, right? They don't know that. We use the HUD-1. They're trying to use a settlement statement. Their software is mostly for settlement statements. They want the documents 3 days prior to closing. We don't do that. The documents come the day before closing. That's just what we do in our world. There's so many things that are different that closings 100% of the time get messed up if we don't use an experienced title company. Home inspection is not required. Appraisal is required. Home inspection is not required. Termite reports are not required. Obviously, we encourage them because it makes sense, but we don't require them. Our world, for whatever reason, FHA does not require it. So my friend who says, I've never done one, I don't know what to do, I say check off the FHA box. I learned a couple other things. Go ahead and fill in HECM 50%. If you have a pre-approval letter, you know what the numbers are. You can put in the exact numbers if you want. Most sellers are okay with 50-50, 50% down. But we give you a pre-approval letter with all the details on it. But addendums are pretty common, right? We do them all the time. The most important thing is to get the buyer and the seller to sign, right? Get a contract, get a valid contract. Anything that needs to be changed, we got this, right? We got this. Let's get this sale to happen, and in a month approximately we're having a closing. Okay, so frequently asked questions. Now here's what's interesting, is our lending limit is $636,150. How many people know what the FHA standard lending limit is? I don't know what it is for this year, but last year, depending on the county, it's around $274,000. Which means that if you're doing traditional FHA financing, 3.5% down, the most FHA will consider that house to be worth is $274,000. And then they put 3.5% down on that, and they do the financing. If they wanted to buy a house more than the county lending limit, then they could, but your buyer has to put down the difference dollar for dollar. So they could buy a $300,000 house by putting $24,000 down plus 3.5%. Everyone with me? Our lending limit is this, $636,150. That's pretty cool, which means that you can sell a house that's worth $636,000 for half price, half cost. If someone wants to buy a $700,000 house, they can, but they got to pay the difference dollar for dollar, and then 50% of the $636,000. Any questions? Pretty exciting. How many people would like to sell a $600,000 house for $300,000? we got a hand here and a bunch of yeses over here. This is a purchase. When we close, the deal is done, sealed. Right? You're getting your check, the seller's getting their money, and the buyer's getting their keys. We're done. We talked earlier about people who wanted to overfund, to put a larger down payment than they're required. Your buyer has the ability to change their mind up to 3 days after with the excess funds. All right, the deal is signed, sealed, delivered. The home is sold. But anything in addition to the minimum down payment, they could change their mind within 3 days and get their money back, the difference. So that's good news that, you know, someone hem hauls for 30 days, doesn't know if they're going to overfund it or not, and then at the last minute said, let me just write you a check. And then they wake up the next day and said, you know, that RV we're going to buy, we're going to have to put that on hold for a year. So let's get our money back. They can do it within 3 days. Now we're getting really exciting. Of those of you that sell homes to seniors, and hopefully all your hands go up here, but for those of you who sell homes to people over 62, how many would you say are over 65, over 70? In other words, do 75-year-olds buy houses? That's the real question. Do 80-year-olds buy houses? And the answer is yes, absolutely. 85-year-olds buying houses. I got a 97-year-old buying a house right now. And you could say, well, that's just not right. A 97-year-old, that's too old. Why is it too old? To live in the house that they want to live in, to live in a single-story house versus a two-story house, to live in a townhouse versus a single-family home that they have yard. Who's to say that a 97-year-old is not going to be with us much longer, right? If that's what's in their best interest, if that's what they want to do, Why not? You know something? You can't take the money with you. Right? What are you saving it for? I get the inheritance. As a father, I'd like to receive, as a son, I'd like to receive inheritance, and as a father, I'd like to give inheritance. But you know something? I hope that the last check I write bounces. I hope the day I die, I've spent my last 10 cents. You know, tomorrow, I'm going to Taiwan for 8 days. Why? That's my kid's inheritance. I'm going because I want to. Yeah, and my son's over there vacationing. We'll go visit him. But I want to, and that's pretty cool. I'm spending my kid's inheritance. Just like the bumper sticker says on the back of an RV, I'm spending my kid's inheritance. An RV is a waste of money, but it's a lifestyle, and it's an awesome lifestyle. You can see the world, see the country, but it's a waste of money. It's right, it's a depreciating asset, and you're spending gas, and eventually it's not going to be worth much. But I'm not criticizing RVs because it's awesome. One of my favorite places is over in Titusville. It's called the Great Outdoors, TGO. Anybody ever heard of it? All right, it's a mobile home community. Oh, you got a yes over here. It's a RV community. They have phases. They have the first phase is just a campground. You just pull your RV in, you got a fire pit, that's all you got. The next one is a pad, concrete pad, and you pay for that. And the next one is a screened-in porch. The next one has a screened-in porch with a kitchenette and a bathroom. Another one has the same thing plus a bedroom. And the ones that have the kitchenette, you have to live in your RV. That's a requirement. But people pull in with $1 million, $2 million RV, and they live the lifestyle. They go travel, and they come back and call this home. And then they go all the way up to $1 million house or even more, where they actually have the garage. There's one house in that community that looks like a castle front. And I'm sure it's remote control, but basically you open the garage door, you open the castle front, because it looks like a tower, and you drive your $1 million RV inside your house, in your garage. But it's a lifestyle, and I've done a lot of loans in there. Nobody else can seem to do them because it's a condominium community, even though it's single-family homes, and it's pretty awesome. But it's a lifestyle. That's what it's about. It's a lifestyle. Buying $1 million house so you can park your RV inside. Really, good for them. If you just were getting ready to sell a house for $267,000 cash money to an 80-year-old, you just about tripled your commission by selling them the house they probably really wanted. The difference between a $600,000 house and a $200,000 house is the lake it sits on, is the size of the house perhaps, but not everyone wants a bigger house. It could be the upgrades available. It could be on a golf course and a lake. Right, it's the lifestyle. It could be the difference of them buying a regular house or buying an RV house where they can park their RV inside. It could be that kind of a difference. The way this loan is designed, we don't know what the housing market's going to do, but houses are supposed to go up at 4% a year. If you go back the history of FHA statistics, 85, 90 years, homes on average, good years, bad years, all mixed together, homes increase at 4% a year. I think that you learned that in your school too, right? In real estate school, 4% a year. Not always. The last 5 years has gone up 10%. The previous 5 years it dropped 20% a year, approximately. So, not always, but the way this loan is designed is the interest is going to accumulate at approximately 5% a year, but 5% on half of the home's value. So $200,000, 5%, $200,000 borrowed, 5% interest for math is $10,000 a year, right? $400,000 value at 4% increasing is $16,000 a year. So $16,000 of additional equity versus $10,000 of no payments made, meaning increased debt, but also meaning $10,000 in their pocket too. It's still a better deal for them because their house is growing in value, not making a mortgage payment, meaning their savings is growing in value. So what's supposed to happen in a perfect world is as the house increases in value and the debt increases, that there's always more equity, or at least the same equity, in the house as there was in the beginning. Make sense? All right, so I've heard people say, well, if you do this kind of a loan, you're going to lose your equity. How? Not because of the loan, probably because of the housing market. Because this year, in 2017, homes may increase another 10%. But in 2018, homes could lose 10%, right? Balance that out. It's zero appreciation in the next 2 years. So on average, they may increase at 4%. Maybe someone did a HECM loan 5 years ago when at the bottom of the market, and the home has doubled in value. Is that fair? Homes have pretty much doubled in the last 5 years. So maybe someone did a HECM loan 5 years ago, and their appreciation has been 12% a year for the last 5 or 6 years. versus they do one now and the homes actually drop for the next 5 years. We just don't know. But the most important thing in retirement is cash flow and cash. Right, Mr. Financial Guy? The most important thing is cash flow and cash in retirement. It's not about your net worth or hard assets. It's about how much money you have access to. Okay, moving on. All right. You think I was excited before? This is my favorite part of the whole class. This really is. This is where I start talking really fast. So, did you know that there's 10,000 people turning 62 every single day? Every single day. And every one of them are moving to Florida. Pasco County in particular. But that's pretty impressive. Every single day we have 10,000 potential new customers. There's 1,000 people of all ages, of course, moving to Florida every single day. Every day. Florida is growing. 24% of the home buying population in Florida is 62 already. Now the people that are already here, on average across the states, 24% are already over 62. But according to the National Association of Realtors, 35% of all the home sales in Florida, 35% of every home sold last year was sold to someone 62 and above. Just think about that. I've had realtors tell me I don't sell to seniors. Really? What, someone call you and say, are you a senior? No, I'm sorry. Click. I mean, that's 35% of your potential production. And you know what? All of us hang out with the people of our own age, right? A 62-year-old hangs out with a 62-year-old, which means when you help them buy their dream home, their really nice dream home at half cost, they're going to tell somebody. They're going to tell their friends or neighbors. If they're moving down from another state, they're going to bring their family or their friends with them. If you're going in and farming a community and you're helping someone move from an older community or maybe a manufactured home community, or you're moving them from a two-story house or maybe a neighborhood that's not as good as it used to be 30 years ago, and you sell them a newer house, maybe a brand new house at half the cost. You sell their house at $100,000, you sell them a $150,000 house for $75,000, keeping $25,000 in their pocket and living in maybe a brand new house or a newer house, less maintenance. They're going to tell all. This is where referrals start to happen. 40% of the U.S. population age 60 are planning on moving in retirement, and of course they're all coming to West Florida, all of them. Joking. 77% of the nation's wealth are controlled by seniors. I put that in here because I've had realtors tell me, oh, I don't need your product, all my customers pay cash. Well, you're missing the opportunity. Sell them a nicer home or help them hang on to their cash in retirement. 86% of all seniors want to age in their own home. That's fair, right? We all want to stay home. You know, we always think about the dreaded nursing home. You know, well, that's the home of last resort. You know, we're talking about living independently. And we're talking, was it you, talking during break about moving in with your children. Right? No one wants to move in with the children, and no child really wants mom and dad to move in with them either. It's all about freedom. It's all about independence. Absolutely is. So people want to live in their own home and they want to be independent, and cash is what makes that happen. Having a single-story house with a maintenance-free lifestyle is what makes that happen. So a better retirement lifestyle for the senior equals a happy client and more referrals. Seniors socialize with seniors. This program over the last 7 or so years is absolutely changing the way retirees are buying their homes. For those realtors who have never heard about this program are missing the boat. So on that note, how many people in this room before today, or before the last couple of weeks, really had heard about this program where you could buy a home at half cost? We have 1, 2, maybe 1.5. No? All right, 1. Isn't that interesting? National Association of Realtors says that 97% of all realtors across the nation don't even know this program exists. Now, we live in Florida. 35% of all homes were sold to seniors last year, and yet most realtors in the state of Florida have never heard about this program. Now, it's not your fault. It's not the realtor's fault. It's our industry's fault. And are you nodding your head? Because it's true. Our industry has not done a very good job educating realtors. And we have a couple of challenges. One, no one's ever heard of a HECM. And reverse mortgages are bad. So why are we doing this? But when you understand the program, it's like quite amazing. It's absolutely amazing. So you in this room are above pretty much everybody in your competition. This is the first time we've taught here, right, Sean? All right, so this is the first time our company, I've been teaching this class for almost 7 years. Been teaching this, the first time we've taught this class in this county, which means that probably nobody in this county, as far as a realtor, knows about this program. And if they have, maybe they've heard about it somewhere. But almost nobody. Now maybe this board has had someone else teach this class, but this is a relatively untouched market. If you as agents want to own a community, a 55+ community, if you want to own a certain area, you take this program and you run with it, and you will be known as the half-cost home realtor. You'll be, yeah. Come up here, Sean. Here's one of the tools that Sean's company helps realtors. We're probably ahead of ourselves, but show that anyways.
We're right at the point, so.
This is pretty powerful. We call this get the conversation started. Buy this home with a HECM for purchase. No one knows what the HECM for purchase is, and that's okay. But it's flexible monthly mortgage payments. We're avoiding the word no because no means no, right? But flexible means, well, it's optional. Oh, both sides are the same. Whoa. Half down payment, age 62+. Pretty much says it all. And what's interesting is there's no phone number on this, which means that they have no choice but to call you because this is going to be next to your sign or in the window of the house that you're trying to sell. You know, it's all about getting the phone to ring. And when you start advertising in a 55+ community, buy the house that you really want for half price, half cost. You're going to get the phone to ring, and then neighbors are going to start talking. You could actually do a seminar in the clubhouse, and people will come. They'll tell their neighbors. This is a way for you. If you think that a realtor's been in this community for 10 years and they own it, and there's no way to get in it, this is a game changer. This is absolutely a game changer. How about this? People come to Florida. They find the perfect 55+ retirement community. It's got all the bells and whistles, a lot of active adult lifestyles, an awesome clubhouse, and they go shopping within that neighborhood because that's what they want. And the house they wind up buying, they're paying cash for, or maybe getting a small loan, is not really the house they wanted because they wanted the neighborhood. The house they really wanted was the golf course one, was the lake one, was the waterfront. The house they really wanted had that awesome kitchen. But they chose that house because what happens though is when they can realize that they can buy the house they really want for half price, you just got yourself a listing and another sale. And all of a sudden the realtor that's been in there, that's not interested in a reverse mortgage for purchase, that's what we used to call it, has no idea where they hit them. They went from being the top salesperson to wondering why they're not getting any more listings. This is the kind of thing that is a game changer. So helping retirees right size into a maintenance-free lifestyle such as a townhome, condo, villa, farming your neighborhoods is going to help you get more listings. Moving seniors from a manufactured home community, which is basically a depreciating asset. And how about those ones that have those huge lot rents? Huh? Yeah. How many people know about those huge lot rents that keep going up year after year? How about the signs that you see down on 27 heading towards Lake Wales that says $50 lot rent the first 5 years? All right, well, wait till the 6th year. All right, that's a lot. I mean, it's $800 a month for lot rent. Wow. So this is a way for you to help them out of those situations into a home that's actually going to appreciate. Helping your client buy a duplex so they can rent out the other side is positive cash flow. Buying a $400,000 duplex, having no payments for $200,000 and renting out the other half for $1,500 a month. I mean, what does that do? Their net worth actually goes up because they have 2 homes, if you will. They have rental income for the rest of their lives. If they don't want to manage it, they hire a realtor to manage it, right? Costs them almost nothing. And when they pass on, they've got 2 properties that's worth more. If you're working, if your clients are working because they want to, then bless them. If they're working because they have to, because the extra $50 a month or $100 a month or $500 a month changes their lifestyle, yet they have a home that's possibly paid for, this makes too much sense. You will have a staggering effect on the quality of your client's life or potential client's life, and mainly because you care. It just feels great. The next segment of this is really not part of the class, but I want to give you some marketing ideas and marketing tools to take this to the next level. I am a 100% believer. I got into the retirement business 25 years ago and then learned about the product, and then I've been doing this loan exclusively for 17 years. I do not do regular mortgages. I do not sell homes. I do not do anything except this. I believe in this too much. It's too much of an amazing program. And on that note, you as realtors, I'm going to say this again, do not sell this loan. Do not sell any loans. Your job is to sell a house, not a loan. You need to know about all kinds of loans because it's part of your job, but your job is to show the house. If someone calls you up and says, you know, I want to buy a house at half price, you might want to tell them how excited you are about it or what you think you know about it, but don't get into too much detail. The best thing to do is, let me put you in contact with a loan officer and they'll explain it to you. Meanwhile, let's get you pre-approved and go house shopping, because that's your job. If someone calls me and says, I want to buy a house at half price, I'm not going to put them in my car and take them around town. I'm going to refer them to you. So do the same thing for us. One of the things that we believe is getting the conversation started. In fact, let me tell you one more story, if I can. For those of you that are in this room and your peers that are willing to listen to you, this program is going to get you a sale or 2 or 5 a year more. Here's an example. A lady calls me up from South Carolina. The state doesn't matter, but she's calling me up from another state, moving to Florida, and she says, you know, I want to be closer to my daughter. I was getting ready to buy a house in one of the Carolinas, and it was half price. It was a heck'em. It sounded great. I went on the internet. I found you. I want to do the same thing in Florida. I said, absolutely, I got this. That's all we do. Our company specializes in the heck'em for purchase. We do refis too, but we love the purchase. And I said, I can put you in contact with a realtor. You know, I love to give referrals. And she quickly stopped me and she said, nope, my daughter has a realtor. I got this. So she comes down to Florida, she calls the realtor up, and the realtor says, what? A heck'em? Never heard of it. Half price? What? Sounds like a scam. Kid you not. So she called me back. I was able to refer her to a realtor that got it. Now here's a realtor that lost a deal because she thought it was a scam. You know, so if you're not 100% convinced, I urge you to get yourself convinced, because it is quite amazing. If you think you've heard some bad things that you might believe, then research it and prove to yourself that it's not. This is an amazing program. I believe it in all my heart. So what I've learned over the last 5 or 7 years or so teaching this class is that now you have the knowledge, and remember a couple of things, you know, 50% down, 62, non-recourse loan, just a couple of basic things, safest loan in America. But don't learn too much. The interest rate doesn't matter. You just need to know what the down payment is, right? That's it. It's nothing complicated. So I teach this class, and in the days back then, I'd call it a reverse mortgage for purchase. All right. As soon as you mention that to a senior, they shut up, not interested, close down. You go sell the home for cash or other financing. So I learned, first of all, get rid of the word reverse mortgage. It's a heck'em. Call a heck'em a heck'em. Call a dog a poodle. But the second thing I learned, that helped a lot. The second thing I learned is if our industry doesn't give your industry things that help you get the conversation started, and I'm going to trademark that because I love it, then your job is to sell a home, not a loan. So what can we do to help you as an industry, help you sell more homes? So the sign that Sean held up earlier is a big help. We have bigger signs too for front yards. That happens to be a window sign. But that's one thing you put next to your listing sign and you get the conversation started. Okay. So here's one of the things that our industry has done. This happens to be ours. And this guy here lives down in actually lives in Polk County, but he sells a lot of homes in Lake Wales. Anybody ever heard of Lake Ashton? Lake Ashton is a 55+ community in the middle of nowhere, Lake Wales, middle of nowhere. Did I say that before? In the middle of an orange grove, if I can say that too, in the middle of nowhere. And they are such a big believer in this product that 40% of their home sales are actually with the heck'em. That they're such a believer in this product that they're advertising all over the place, including Tampa, for seniors to buy homes at half cost. And they go one step further and say, you can buy this $210,000 home for $96,000 if you're 68 years old or whatever they say. But they're advertising it. They're getting people from Tampa to move out in the middle of nowhere, because where else would they get customers? It's pretty cool marketing. So this is one of the flyers. Look at this one here, $189,000 house, nice looking house, $189,000 house. Someone could buy for $100,000, and that's if they're 62. But what if they're 75? It's down to 83. That right there could get you a deal a year. Getting the conversation started. They're going to call you and say, well, tell me more about this. Taking that picture and PDFing it, making it a picture, and putting it on social media will get your phone to ring. That's pretty cool. And as realtors, as salespeople, we all want the phone to ring. Even if a 30-year-old calls you and says, how can I buy that home for $100,000? Well, you can't, but I have a loan officer that will help you get pre-approved and we'll get you some financing. So everything is branded to you. And same with social media. We have, you know, pre-designed ads. We have all sorts of pre-designed stuff where you can just start promoting this. You know, if you do it right, there's no cost for this. So, all right, so we have also come up with a trifold that is unbranded, that you can staple your business card to, again, to get the conversation started. These home signs we've come up with. We have open house signs, and then the sign that Sean showed you. And then 6-foot banners, trade shows, open houses, lobby of your real estate office. And then this is pretty cool. Now, I haven't gotten Pasco County, but I'll get with them to have this approved. But we've gotten this wording in red approved by most MLSs across the state of Florida. It's generic enough. It doesn't say a lot. It doesn't say 50%. It just says large down payment. No monthly mortgage payments, which is approved by HUD, approved by all the lenders. Use this wording in your MLS listing to get your phone to ring. You will get seniors to call you. You'll get other realtors to call you. You know, what's going on? They'll think that this particular house is the only one that they can get for one large down payment and no monthly mortgage payments. And that's okay if they want to believe that initially, because you want your phone to ring. Obviously, we're not going to deceive them, but that's what they're going to initially think. The other thing we can do is there's a PDF flyer. I don't know if it's coming up next. No, it's not. There's a PDF that we have also approved that you can upload to your supplement section where other realtors can see it. So when you get a call from a realtor, which is really not a customer, you really don't want to waste your time, right? You can just tell them to go to supplements and read all about it. And that way you can sort of move on to the person who's actually buying the house. So we learned that also. Now this right here is probably one of our best things. It says it all, right? halfcosthomes.com. It says it all. On this, there is 5 basic benefits of this website. First of all, there's a HECM education. What the heck is a HECM? It explains it all. Number 2 is there's a search engine. We've hooked up with Realtor.com, which means that every house that's listed on MLS is on Realtor.com, which means that every house that's on MLS or Realtor.com is on our website. So somebody could type in Pasco County, 3-bedroom, 2-bath home, find a house that they want, figure out that that house is $200,000, go to our calculator, which is on here, and type in that and their age, and poof, it gives them their down payment. Now here's the magic of this, is we're not asking them for any information. They can use our website for free without lead capturing. You know, don't you hate that when you go to a website and the first thing that pops up is give me your name and phone number? We don't do that. Instead, they can use the calculator, which is very simple. What is your age? What is the home purchase price? And bam, there's your down payment. Very simple. But on every single page is a lead capture form right there, on almost every single page. So allow them the ability to say, get me pre-qualified, locate me a realtor, help me understand more, call me. When a realtor is attached to this, and you have the ability now for no charge to be part of this website, the lead goes to you. And how it goes to you is 2 ways. One, either they look for Pasco County and they want to find a realtor and your name's on there and boom, they call you, or that you forward this website, maybe you put it on social media. You've been affiliate ID tagged on it, which means if they come to this website because of your link, and when they fill out a form, you get the lead. It's automatic. It's pretty cool. And then locate an eligible realtor, which is a search engine for realtors.